$500. You see that number and you already feel something. Maybe it's dismissal, that's not enough to matter. Maybe it's mild panic, I don't have $500 extra at the end of the month. Maybe it's skepticism, another compound interest video, another projection that doesn't account for real life. Whatever you felt in that first second, notice it. Because that instant emotional response to a number is exactly what this video is about. The amount isn't the problem. Your brain is the problem. And once you understand what your brain actually does with $500 a month, and what it does to a decision you make about $500 a month, the math almost takes care of itself. Let's start with the brain. In 1998, behavioral economist Richard Thaler ran an experiment with employees at a mid-sized American manufacturing company. Thaler would later win the Nobel Prize in economics. At the time, he was trying to solve a problem that every financial planner already knew: people know they should save more, they want to save more, they sincerely intend to save more, and then they don't. Thaler and his colleague Shlomo Bonatzi designed a program called Save More Tomorrow. The concept was almost embarrassingly simple. Instead of asking employees to save more right now, which felt like sacrifice, like giving something up, they asked employees to commit to automatically increasing their savings rate every time they received a raise. The increase would happen automatically. The money would move from paycheck to investment account before it ever appeared in their checking balance. They didn't have to do anything active. They just had to say yes once. Within 4 years, the savings rate of participants tripled. Same people. Same income. Same expenses. 3 times the savings. The only variable that changed was the moment the money disappeared from view. This is the central insight your bank doesn't want you to sit with for too long: you don't feel money you never see. The psychological pain of saving and the psychological pain of spending are both real, but they only fire when you can see the money. Remove the moment of decision, and you remove the pain. Remove the pain, and the behavior changes completely. Now let's follow the math. $500 a month, invested in a broad market index fund that tracks the performance of the largest companies in the economy, has historically grown at an average of roughly 10% per year. That's the long-run average annual return of the S&P 500 going back to 1926. Not every year. Some years the market drops 30%. Some years it climbs 25%. But over rolling 30-year periods, the long-run average sits close to 10% annually. At that rate, $500 a month becomes roughly $100,000 after 10 years. Roughly $370,000 after 20 years. Just over $1 million after 30 years. $1 million from $500 a month. Not from picking the right stock. Not from timing the market. From consistency and from time. Most people's brains short-circuit right there. 30 years sounds like a different lifetime. It sounds like a projection made by someone who has never faced an unexpected expense, a job loss, a medical bill, or a family. It sounds like a fantasy built for someone else. And this is the trap. Because the same brain that dismisses a 30-year investment horizon has no difficulty committing to 72 months of car payments, or a 30-year mortgage, or a monthly subscription it will renew without thinking for the next decade. Your brain handles long financial commitments every day. It just prefers the ones that involve spending. Here's the research that should reframe how you think about this. Every year, a financial research firm called Dalbar publishes its quantitative analysis of investor behavior. It compares 2 numbers, the actual annual return of the S&P 500 over time, and the actual return earned by the average equity fund investor over the same period. The gap is large. Over the 30-year period ending in 2023, the S&P 500 returned an average of roughly 10% per year. The average equity investor earned just over 6% annually. Not because of bad luck. Not because of unusual expenses or bad timing in their personal lives. Because of behavior. The average investor bought when markets were exciting and sold when markets were terrifying. They let their brain, specifically, the part that processes financial loss the same way it processes physical pain, make decisions that cost them nearly a third of their potential returns. 6% versus 10% looks like a small difference. On $500 a month over 30 years, the difference is the gap between $500,000 and $1 million. Your brain, operating without guardrails, is the most expensive thing in your financial life. The solution isn't more financial knowledge. It isn't discipline or willpower. Every major study on investment behavior points to the same conclusion: the more active decisions you make about money, the worse your outcomes. The investors who outperform the average over long periods aren't smarter or more informed. They're the ones who set a default and then got out of the way. Vanguard, the firm founded by Jack Bogle in 1974, the man who created the first index fund available to ordinary investors, has published extensive research on automatic enrollment in retirement plans. When companies automatically enrolled employees at a default contribution rate, participation climbed from roughly 67% to over 90%. Those auto-enrolled employees didn't gain new financial knowledge. They didn't develop stronger savings habits. They simply never had to actively decide. And because they never had to decide, their brain never had the chance to talk them out of it. The enemy of your future is not your income. It's the gap between deciding and doing. Automate the decision, and that gap disappears. Now let's look at your real life right now. The average American household spends approximately $240 a month on dining out. Roughly $150 on subscriptions, streaming, apps, memberships, many of which they've forgotten exist. Around $200 or more on convenience spending, delivery fees, parking, impulse purchases, the things you buy without planning. These aren't judgments. They're averages from real household spending data. Those three categories alone add up to nearly $600 a month in spending that, if you surveyed those same people a week later, they could not fully reconstruct. You are almost certainly already moving $500 a month through your hands without remembering where it went. The question isn't whether you have $500. The question is whether your brain ever sees it, or whether you make one decision today that routes it somewhere else first. Behavioral economists call the psychological mechanism at work here hedonic adaptation. When something changes in your life, a higher salary, a new apartment, a new phone, it feels significant for a short time, and then it becomes the new normal. Your baseline shifts. You stop noticing. This same process works in your favor when you automate savings. Within 1 or 2 months of $500 disappearing before your paycheck hits your account, your brain recalibrates to the new baseline. The money is gone, not because it vanished, but because your brain rewired what normal feels like. The people who build wealth quietly over decades are not exercising more discipline than you. They automated the decision long enough ago that they genuinely stopped noticing the money leaving. Spend what remains after saving. Not save what remains after spending. The math is the same. The psychological reality is completely different. And here is the piece most personal finance content gets wrong about starting late. If you are 35 and haven't started yet, you've been told a version of this story that ends with "it's almost too late." That framing is designed to make you feel hopeless, and hopeless people don't change behavior. Here is the actual number. An investor who starts at 35 and contributes $500 a month for 30 years ends up with over $1 million. An investor who starts at 45 ends up with roughly $380,000. An investor who keeps delaying ends up with whatever spending habits leave them. The math clearly favors starting earlier. But the math also clearly favors starting now over not starting. The most expensive financial decision most people make is waiting until the moment feels right. The moment never feels right. There is always a better time just around the corner, a more stable month, a raise coming, a debt to clear first. The brain generates these reasons because action feels like risk and inaction feels safe. But inaction has a price, and it compounds too. $500. You had a feeling when you saw that number at the beginning. If that feeling was "this won't work for me," I want to offer you something more useful than motivation. Your brain is not your enemy. It is doing exactly what brains do, protecting you from perceived pain, resisting unfamiliar commitments, defaulting to what feels familiar. That's not a character flaw. It's biology. But biology is not destiny. Richard Thaler's employees tripled their savings not because they became better people. Because one decision removed the moment where biology could intervene. The investors who retire with more than they ever imagined don't have more discipline. They have better defaults. And defaults, unlike discipline, do not require maintenance. You don't need willpower. You need one decision and the right automation. $500 a month. Moving before your brain sees it. For as long as you leave it alone. That's not a projection. That's a mechanism. And it works exactly the same for you as it did for every person who set it up and then forgot about it, and one day looked at a number on a screen that their brain had quietly built without them.